So Neil, let's get into your framework. I remember a line of yours at the end of last year. I remember you sent me a message and you said the labour market is no longer a reason to be hawkish. And I thought it was really important at the time because it wasn't just that the labour market was somehow weakening or deteriorating. It was that even with labour market strength, even with economic growth, that was no longer a reason per se to be hawkish. Neil, can you just walk us through how you're thinking about the economy with that in mind?
Yeah, sure. Thanks, John, for having me on. Well, compensation growth equals inflation plus productivity. Okay. And we know that compensation growth is moderating. There's a lot of focus, of course, on wages because that's the monthly data. But, remember that benefits are slowing a lot more rapidly than wages and salaries. And in theory, workers bargain over their entire compensation package. And when you look at quits are basically below where they were just before the pandemic, and it suggests that broad measures of compensation growth, like the employment cost index, will be, somewhere in the vicinity of 3% by the end of the first quarter. Now, if you have 3% compensation growth, and we know that productivity is normalizing to around 1.5%, where's the inflation coming from? So if compensation is 3, maybe 3.5, and productivity is around 1.5, then you're at the Fed's underlying inflation objective of 2. So there's a lot of focus right now on things like goods prices, producer prices. As I mentioned last time I was on the program, Lisa's very focused on chocolate prices.
Very.
But there's limited pass-through from those things into core consumer prices. And I do think that the normalization of labor market conditions will take a lot of the pressure off of services, which are running, well above what they normally run above with respect to goods prices.
Now, one take that we heard last week repeatedly, I think across the street, including from yourself, was that the Fed was embracing this supply-side narrative. Could you briefly describe that a little bit more broadly and help me understand, how do you set monetary policy when it's the supply side doing all the work?
Well, I think first it's important to understand why the supply side looks better. I think that's primarily a function of normalization dynamics following the pandemic. So, this time last year, labor productivity growth was deeply negative, and now it's normalizing. That essentially raises the speed limit for the economy. So if you have stronger economic growth, as Powell mentioned, you could have stronger employment and economic growth without necessarily pushing inflation higher. And I think that's why it's important. It gives the Fed room to kind of recalibrate policy. That's why it's important. So productivity's up. That gives the Fed a little bit more space to ease, modestly if inflation's slowing more quickly.
Neil, I'm having a hard time, and I'm having a hard time for a number of reasons, partly because it's very hard to find people who can really pose some sort of negative case. But there is one to be made with the data that is coming in hotter than expected in certain areas. You talk about the fact that wage inflation seems to be nowhere. The New York Fed has a new measure of trend wage inflation that Torsten Slok put out this morning, saying that it's currently running at 5% and looking pretty sticky. Other measures showing that inflation is reaccelerating, with Jim Bianco saying this no landing is going to pose a real problem for bond markets. How do you dismiss those things out of turn and retain faith in the disinflation story?
Well, you have to go to first principles. I'm not a big believer in indicator macro. I don't like going and saying, look at this indicator, see, it's up. Well, that's, again, as I mentioned before, looking at the wage number, that's one thing, but people bargain over their entire compensation, right? That's just, to me, that's a red herring to distract people from the best measure of compensation growth, which is the employment cost index, okay? There's minimal pass-through from goods into core consumer prices. But as I mentioned, first principles. Where is the acceleration in household and corporate measures of inflation expectations? Where is this showing up in earnings calls? Where? Costco's talking about basically holding the line on prices. Walmart's talking about bringing their rollback back. So, if households expect inflation to basically be, those expectations have been coming down in the last few months. It would suggest that, the inflation upside surprises that we've seen in the realized data will be fleeting. Well, but I'd also point out, Lisa, that inflation data has been generally on the weaker side of the consensus overseas. Interesting. It would support the idea that I think the Fed is putting a lot of currency into, I think rightly, that residual seasonality is a big driver of why the inflation numbers looked a little bit worse in January and February.
Then, Neil, if that's the case, do you reject this idea of a reacceleration of the economy in some sort of material way and a broadening out around the world and say that that's premature because there is more weakness under the hood and, frankly, challenges to certain businesses that don't have the pricing power that would suggest that the Fed was justified in cutting now?
I think, to me, the strength of the economy, that's a reason to expect a ceiling on how many cuts the Fed can deliver. It's not a reason for the Fed not to cut at all. I think part of this is we're all very used to the Fed cutting a lot or not at all, because primarily it's, they're cutting aggressively to stop a recession from gaining hold, or they're already too late, and that's why you're in a recession, you have to cut a lot. What I'm talking about is just a recalibration of policy. It's difficult to see the Fed cutting 6, 7 times because, as you mentioned, the economy's strong. But if inflation is falling, they can at least adjust policy a little bit to kind of reset the economy. This isn't a outright easing. It's just simply taking policy from significantly restrictive to maybe a little bit less restrictive. That's all. I mean, this isn't like a broad wholesale change. I think that's kind of the sort of thing that people are getting, I think, in my view, confused by. This isn't a wholesale change of policy. It's simply a recalibration of monetary conditions.
Neil, I'd like to finish there because I think those words are really important. Just how bullish the reaction function of the Federal Reserve actually is, because many people ran away with the idea that it was super, super bullish. Neil, I just wonder how close we actually were to having a very different conversation. If that median dot had shifted from 3 cuts to 2, and it was very close to doing so, do you think the conversation would have been very different after the Fed meeting Wednesday?
Not really, because what would have happened? My sense is that the the markets probably would have sold off a little bit. Certainly the expectation going into that meeting, John, was that, we were kind of gravitating. The risk was for 2 cuts instead of 3. And maybe if they penciled in 2, the markets would have taken that and sold off a little bit. You would have seen a modest tightening of financial conditions. But then guess what? Chair Powell would have come out, struck the same dovish tone, and then markets would have rallied. So I don't know. I think the big story is they're cutting. They're just not cutting as aggressively. The strong growth in the economy puts a ceiling under how many cuts they can do, and that's also in the dots. That's in the outlook for 25 and 26.